Hi, and welcome to this week's episode of the CostofCarry podcast. My name is James Chi. Let's get started. Now that we're heading into the final month of the year, I thought it would be a good opportunity to highlight a few case studies that you may consider relevant heading into the next year. Of course, nothing here is specific to your situation, and this discussion contains a mix of hypothetical situations and also adaptations from my clients' success stories. And both the details in each situations have been, omitted and changed and fictionalized in order to apply a more general and conceptual understanding of what has happened. So I hope these help, and if there's anything that you feel as though you would like for me to explain, then I'm happy to do so. So scenario 1. Refinance a commercial property with no annual reviews. Annabelle is a Brisbane-based psychologist. She runs her own practice out of a small office space that has a loan on it and is currently in the principal and interest phase of her loan. After experiencing a domestic hardship event, Annabelle now needs some extra cash flow in her business so that she can make up for the lost time and money spent with solicitors. She visits her accountant to discuss options for either increasing revenue or expenses or decreasing expenses in her business. But the accountant quickly points out that a significant portion of Annabelle's business expenses come from her monthly loan repayments on the office. Annabelle approaches her broker at Ding Financial, and the broker looks over her loan statements and tells Annabelle that it would be in her best interest that she thoroughly considers an interest-only loan in her comparison sheet with no annual reviews because of the fact that the business's income can fluctuate and her working and billing hours could drop now due to being a single parent. Over the course of 10 weeks and multiple discussions with Annabelle's accountant, the broker is able to find a suitable lender that is able to provide a set and forget facility with 5 years interest only on the balance of the loan, based off Annabelle's strong and clear credit and business performance. Now, that was just obviously a quick overview of the scenario or situation. But let's weigh up a few of the pros and cons that were expressed. So the pros are a no annual review facility was achieved, which basically means that whatever the financial situation or property valuations that are ascertained at the beginning of the loan application are consistent, will be used over the time of that loan. Secondly, the interest-only feature of the loan product means that Annabelle and her accountant can work out an increased business cash flow because obviously an interest-only repayment is less than a principal and interest repayment. Whether or not it's a significant or small amount depends on, obviously, the borrowing situation. But the purpose of the interest only in Annabelle's case was to adjust to a new lifestyle, and being in a situation where, there needs to be more cash available in the business, because of her hardship event, allows for her to, have that buffer available for when and if she needs it. And also, lastly, the last benefit of this in this situation was that it was a relatively quick turnaround from start to finish. And what I mean by that is, okay, 10 weeks doesn't sound quick, but definitely in the commercial space, there's a lot of it's not as straightforward, as a residential loan, which is, based upon regulations and certain requirements such as pay slips and things like that. When it comes to commercial lending, we're obviously considering a lot more things such as, is it a going concern? Is there a lease in place? What's the business forecast? Are you able to explain how the management will run in Annabelle's position if she's, in and out of the office? Things like that. So there's a lot more to, although the 10 weeks sounds like a lot, the reason why that is because there's also a lot to cover, and the information requirements are also just as extensive, because the broker has to make commercial sense of the finance and the lend. If it doesn't make commercial sense, then it's not likely that the finance will go through, because people don't just borrow money for the sake of borrowing money. They're obviously borrowing money for a reason. And so 10 weeks to cover all of this is relatively quick. Yes, it can be done sooner. It just depends on the complexity of the situation. So simple things can be done a lot sooner, whereas more complicated things can take a little bit more time. But in the end, in order to get what you want, you may need to spend a little bit more time on it, and in that case, it is not a bad trade-off. So what are some of the cons? Product features entailed. So in Annabelle's case, the product features entailed are slightly higher than she was previously on. And, straight off the bat, this is probably the most obvious thing. Going on an interest-only product can be more costly in the long run. And what I mean by that is because during the interest-only period, you're not paying down any of the principal. You're only paying the cost of holding the money. And so because of that, some lenders may charge a loading rate on the regular P&I rate. Some don't, but in most cases there are. And over time, this can lead to, what they call a revert rate. And what happens over this time is that once the interest-only period ends, you need to be able to show servicing or capabilities that you can manage the new repayments over that shortened loan term on a P&I repayment structure. Because say for example, and this isn't in Annabelle's case, you were given a 25-year loan term with 5 years interest only. Now instead of saying that you can repay the loan over 25 years on a P&I rate, which isn't the case, you would have to be able to show that you could repay the loan on a 20-year term, if that makes sense, because technically those 5 years of interest only don't really affect any of the principal. And so that's one of the main things. So, obviously in that case, and I didn't mention this in the scenario, but for people who are on that loan, such as Annabelle, there is a bit of a business case and, like I said before, a demonstration that you can either exit the loan before it matures or be able to pay it off. So in that case, that can be a little bit of a problem for some borrowers. but I thought I'd just highlight the positive case in Annabelle's situation. And lastly, and this ties on to the first one, is that Annabelle, and I didn't mention this, but Annabelle would also like to have borrowed more money than she was allowed, and with some of this as cash for the business. Now, the reason why she couldn't do this was because of certain servicing ratios and requirements. Now, in comparison to residential servicing, which is somewhat less than commercial servicing, Annabelle was again faced with this issue of being on an interest-only loan means that she couldn't borrow as much because her repayments were going to be occurring over that 20 years instead of that 25 years as we used in that previous example. And so, look, that's something to weigh up, because obviously if you need a certain amount of money, then this should be obviously one of your main considerations, but it shouldn't be a deal breaker. Now, every situation's different, but obviously if you can get the lender who can tick more boxes than the others should be your, or wouldn't be a irresponsible way of making your decision, or an unsuitable way. It would just mean that, okay, it's clear that you can't get everything you want. Now we have to decide which is more important. And as shown in Annabelle's case, maybe, the borrowing amount wasn't as important. Maybe she got a little bit more, but not as much as she wanted. So that's just something that she'll have to work around with her accountant. So when each person comes to me, I never expect that their wish list is going to be the same as my last customer. Of course, price is an important aspect, but it was clear here in Annabelle's case that cash flow and flexibility were primary and price was secondary. And it's vital for a broker to get this understanding from the client, because it helps set expectations and create lender search patterns of who not to go with and what to avoid. Scenario 2. Making a house a home with a gut renovation. Adam and Nico are a recently married couple that are thinking of renovating their small home to raise their children and pets. Adam is a PAYG architect and Nico is an interior designer, and both have moderate incomes but have a strong pool of savings. Since they want to do up the property they currently live in, they have considered renting elsewhere until it's all done, and this new expense will be taken into their assessment. Adam sees his broker at Ding Financial to sort out the viability of the project, and having seen this type of loan before, he is able to provide the couple with some general facts and figures to help to keep in. He's able to provide the couple with some general facts and figures to keep in mind, such as line fees, fixed price building contracts, and the duration of the project. Unfortunately for Adam and Nico, the timing of the project wasn't going to work, as there were outstanding items that they were waiting for from the builder and council, and they instead decided to plan for their application in the meantime, so that when everything is ready, the broker can submit the loan application through. 3 months later, with the insurances in place and council stamp plans and construction approvals and contracts in place, Adam and Nico are eager and ready to build and reapproach their Ding Financial broker. Being aware and prepared of their intention, the broker can easily prepare the file and application to submit to a lender from their available options, which is done after Adam and Nico review and sign the information collected and comparisons provided. Within 8 weeks of submission, and completing 2 valuations, the loan settles and the construction work can begin, with progress funds being released in stages. Adam believes that the build will take 6 months and will turn their outdated and outgrown property into the best house on the street, the perfect place to raise a family. Now let's weigh up the pros and cons of this situation. So the pros were a fast turnaround, the building money was achieved while taking into account their new living arrangement, ability to refinance once construction has finished, and also the broker was able to keep the lead warm for 3 months. Now the cons. They had to wait from their initial time of interest and from approaching their broker. There was a slight price increase to reflect the increased risk in the changing security states, and also a requirement for 2 valuations. Construction and renovation, or use the two terms interchangeably, can be a tricky thing because everything needs to be in place before the finance is sought. And what I mean by that is that it's hard to do construction on the promise that a DA will be approved and put in place, or that the job will cost so and so without the building contract available. In this situation, the broker from Ding Financial did the right thing by keeping the lead warm, by getting everything ready, then doing a quick review before submitting to the lender of their choice. Obviously, the security used in a construction deal is first decreasing in value before increasing again. And this is because it's changing state from a habitable or completed property to a part completed property and, a work in progress situation. And then finally, through the work done, it transitions to a habitable and improved and completed property. Now, with this in mind, the valuations and price shouldn't be of concern as much as everything else that you may have on your wish list, because these are integral parts in proving the feasibility of the project in terms of risk and resale. And just going back to that initial point of being able to refinance once the construction has finished. Now, a possible situation for Adam and Nico that they may decide is that if the property improves in value by, say, 40%, for example, 50%, they may decide that it is worth refinancing the loan to get that better home loan rate. Because now that the construction has ended, there is no, the new loan amount, which is the initial mortgage plus the construction, can be valued against the new home loan. The new home value, which, may improve their rate and repayments at another lender. So once they give that instruction to their broker to go and search these options, then their assessment, so Adam and Nico's or the borrowers or the homeowners, their assessment of the situation can be done a lot more, can be done better because they now have the new LVRs, they have the new interest rates, new repayments, things like that. And, for this to have taken 6 weeks or 8 weeks, sorry, that is a very good turnaround time. Valuations can take a little bit of time to prepare, such as the long form ones. They can take up to 10 days, 2 weeks. So having everything in place beforehand just streamlines the process and makes there be less hurdles to go through in assessment, which I think is one of the most important things in producing a positive client experience or customer outcome, because not only can the assessor just have everything in one place, but then the broker also knows how to present and position everything to the lender so that they have all the information and can go through their checklist as quickly as possible. And on that note, that concludes this episode of the CostofCarry podcast. Thank you all for tuning in, and I'll see you in the next episode.